Hello, I'm Veeman Tran, Senior Investment Officer at Colchester Global Investors. I have recently joined the company, in fact, at the beginning of the year, after I spent over 22 years at Franklin Templeton managing global fixed income portfolios. But first of all, I would like to thank Consejo Consultivo de Finanzas Verdes the opportunity to speak at this impressive conference and share some of our ideas regarding sustainable investing in global fixed income. Today, I will go through a short presentation about Colchester, who we are, what our investment philosophy is, and how we integrate ESG into our investment process, and give practical examples how we can use specifically environmental constraints, namely carbon emissions, to build sustainable global fixed income portfolios. So Colchester, so who are we? Well, Colchester is an independent asset manager that is majority owned by its principals and employees. We feel this is very important because this aligns our clients' long-term interests with the team's long-term interests. We are global sovereign specialists with no allocation to credit, and this allows the diversifying integrity of sovereign bonds versus riskier fixed income and equities. We only invest in physical cash bonds with no derivatives, and so with the exception of FX forward contracts, which is used for the purposes of hedging. And this ensures that we maintain very liquid portfolios, so pure cash bonds that we own. Our assets under management is approximately 40 billion US dollars. We have a disciplined and repeatable approach where we use one investment process for our strategy. So what is our investment philosophy? Well, as value-oriented investors, what matters to us most are real returns for bonds and currencies. We build bond and currency portfolios separately. So as you see on this chart here, on the bond side, our aim is to invest in bond markets with the highest real yield. And the real yield is simply defined as the nominal yield minus our 2-year inflation forecast. And this real yield is then adjusted for our financial stability score for each market, which is made up of the internal balance sheet analysis and ESG considerations. On the currency side, on the right-hand side here on this chart, we use a PPP framework, i.e. the purchasing power parity, to identify real currency valuations. Again, this is adjusted for our financial stability score, but here we look at the external balance sheet and we combine that with the ESG considerations. We also take account of the differential in short-term real interest rates to give our overall currency evaluation. So as you can see in this chart, this gives us an overview of how we value bonds and currencies. So focusing on ESG in particular, Colchester has adopted responsible investing since the inception of the firm in 1999. Colchester is also a signatory to the UN PRI since December 2016. And why is ESG important to us? Well, we believe that as medium to long-term bond investors, countries with better ESG practices and policies, i.e. governments that can effectively implement sound policies and have a healthier, educated workforce in a clean and safe environment, tend to produce better economic growth, more stable balance sheets, and therefore more sustainable financial outcomes. Taking a closer look at ESG factors and their indicators, for example, so let's take governance. And we can look at many indicators within governance. So here, the rule of law, control of corruption, strength of institutions, effectiveness of regulation, voice and accountability. And these are, in fact, some examples of the World Bank's governance indicator. And conventionally, these are included in our sovereign risk assessment. And the strength of these indicators have an impact to a government's ability and willingness to finance its obligation. So this chart shows a strong correlation between countries with strong governance score and higher GDP per capita. The next two factors, social and environmental, we are seeing growing areas of awareness, which has led to the adoption of the so-called is the UN Sustainable Development Agenda 2030, which are 17 goals to build a more sustainable future. And of course, the Paris Agreement relating to the impact on climate change. With the COP26 recently, it is clearly the center of focus. So what are the social factors that we look at? Well, education, the health, the level of inequality. Clearly, there is a greater emphasis on human capital and social cohesion as a determinant of economic growth. And we recognize that better quality of life and better social conditions improve productivity of a country, and therefore we would expect better long-term sustainable economic outcomes. So if we look at this chart here, this shows a link between the quality of education versus a country's productivity. And so, for example, South Africa here ranks very poorly in terms of quality of education, and this is reflected in its low productivity. So poor productivity, we believe, will have a negative impact to long-term growth. Finally, the environmental factors, and out of this, the E, S, and G, there is less of a consensus on what is deemed as good sovereign environmental performance. But to help us monitor the impact of environmental risk, for example, obviously climate-related risk, we look at a country's exposure to two types of risk, transition and physical risk. And the physical risk is the risk associated with extreme climate events or environmental incidents. And you can see here, we can look at indicators such as the World Risk Index, the Yale EPI, and the resource management, which assesses a country's exposure to extreme hazards and country's ability to cope and take measures to mitigate risk. Now, transition risk is the risk associated with the process of adjusting to a low carbon economy. And of course, we can look at CO2 emissions, energy intensity, renewables, and we will talk about that in a little bit more detail later on. The chart here shows a positive relationship between good environmental performance index score with higher GDP per capita. So on this page, we summarize how we holistically integrate ESG factors, as I just described a moment ago, into the balance sheet, i.e. assessing the debt, the fiscal position, as well as the external balance sheet. And through playing a role in engagement, we can push the ESG agenda so that we can better understand the risk and account for them in our financial stability analysis to arrive ultimately at our adjusted valuations for bonds and currencies. So looking at ESG, what we tend to find are countries with strong country balance sheets also have strong ESG factors. So where we see weak ESG factors, this negatively impacts our financial stability score. And we apply a discount to our bond and currency valuation as a consequence. ESG is for us always an ongoing process. It's always been an integral part of our investment process, and so that we can better deliver long-term risk-adjusted returns. With this ESG framework and investment process in mind, we have the tools now to build sustainable investment strategies. And so when we think about environmental transition risk, we also obviously think of measuring global carbon emission. And as I mentioned, the recent COP26 meeting discussions on what should be done about the threat of climate change, there is or agreement that countries collectively need to reduce carbon emissions, but the share of responsibility between regions or countries have not been easily agreed. And this is because it really depends on how we measure a country's level of emissions. And for a sustainable investment strategy, the measure portfolio outcomes. So the measure is extremely important. So examples how we could measure CO2 emissions for any given country, we can look at the total CO2 emissions, CO2 per capita, or CO2 per unit of GDP, or a country's historical contributions, which may relate to its change over time. So the question is, what is an equitable measure of a country's carbon emission? So as an example, if we take total fossil fuel CO2 emission as a measure, we know that China is the highest emitter in the world in terms of total emissions. And of course, ranked last in the table of this select group of countries I have here on the right. But if we correct for its population, the country's ranking improves. But using total CO2 emission for a country, this is likely to be this is likely to be a function of its population, and so we have to be careful about this particular measure. We can also look at carbon emission per unit of GDP, and this, however, tends to benefit nations such as the Scandinavian countries. As you can see, they are highly ranked based on this carbon emission per unit of GDP. Or perhaps carbon emissions can be based on emissions over time or consumption versus production. To illustrate this consumption versus production in this next chart, the blue bar is the consumption and the gray bar is production. You can see that US production emissions is a lot less than its consumption emissions, but if you look on the other side of the chart, this is the opposite for countries like India. So as you can see, that depending on what measure we use, we can label a country a high emitter, and based on another measure, it is a lower emitter. So with that in mind, we can arguably take one of these measures and build a sustainable investment portfolio. So we can demonstrate by using a very simple mean variance framework to satisfy a sustainable investment objective, i.e. One of these CO2 measures that I just talked about. And we can improve the carbon emission of a global bond portfolio compared to, for example, WIGB or maybe another global bond index. So, so going through a simple example, and in this example, I've taken the carbon emission per GDP as a measure. So what we're looking at here is the historical difference in emissions between our actual global bond strategy versus the benchmark over the last decade. And as you can see, in this chart, the strategy is above zero most of the time, and which it indicates that the strategy has generally scored higher in carbon emission versus the benchmark. Now this chart shows even without carbon constraints, and by simply following an optimization based on our real yield analysis, emissions of this strategy versus benchmark can still vary. So if we were to take a constraint, we can begin to see the relative impact or the cost to our global bond strategy based on the active investment value. Here, you can see on the x-axis various constraints of carbon emissions versus the benchmark, while we're trying to maintain similar tracking error to an unconstrained portfolio. So what we can see here is that we can still expect to achieve greater investment value versus the benchmark, and obviously the looser the constraint, the higher expected excess investment value, and vice versa. Which means really, if we want to have less than the benchmark, i.e. a cleaner portfolio in terms of carbon emission, the degree of active investment value generally falls, but we still can expect to achieve positive active investment value. So clearly there's a cost to adopting variations of sustainable strategies. This chart here looks at the differences in active investment value over time. In other words, this reflects the associated cost of a 10% carbon constraint versus benchmark. Now, you can see there are times where there is a difference in investment value at any particular point in time, but it is not always the case. So we can build a portfolio that optimizes our investment strategy with a 10% below benchmark carbon constraint. And this page summarizes this type of portfolio where we've optimized constraints. And what we can demonstrate here is that not only we can satisfy the sustainable strategy of being less than 10% versus the benchmark, we can also achieve the similar yield to an unconstrained portfolio, similar credit rating, and positions don't really change very much based on this, this optimization. We can also add various additional themes to this strategy by adopting green bonds into the portfolio. And as you can see on this chart, we can maintain, again, a 10% carbon emission below the benchmark, as well as have exposure to green bonds. And this, for example, shows a conservative exposure to green bonds around 50% in green bonds, with very little change to our exposure to duration, yield. So we maintain yield similar to our unconstrained portfolio, as well as the credit rating. Now, this chart summarizes the various examples of carbon constraints with or even without green bond exposure, and we can compare and contrast what we can do, which means that we can build a whole host of customized portfolios to meet different objectives of carbon emissions and green bonds. In conclusion, what we have just demonstrated here are practical solutions in integrating environmental constraints into global portfolios. But we have to remember that the choice of carbon measures and the degree of carbon constraint can change the optimization profile. So it's really a compromise. And what we really can do is to build a cleaner carbon portfolio, but it requires judgment. Importantly, these sustainable measures are transparent, they can be monitored, and they can be reported. So thank you for your time. And if you would like to have more information, please reach out to our marketing and client service sales team on this website. Thank you.